What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Research Survey. In this week's episode, we'll be discussing why markets fall, referencing a study we published a while back looking at all 10% or greater corrections in the S&P 500 over the past 60 years. On our podcast website, what'snextformarkets.com, you can view a handful of the supporting charts from this study under the show notes of the episode. I'll be speaking with Stephen Gregory, my long-term colleague who heads up the quantitative research effort at Piper Sandler. Hey, Stephen.
Hello, Michael. I'm excited to talk about this one today, and I think it's pretty timely given what we've seen in the market being down this past week and the concerns people have had all year. There's a lot of reasons, a lot of talking points out there on why to be concerned about the market at a time where we've had such good performance in the market over the last couple of years.
Yeah. And one of the things I want to mention in what you just said, you said all year, like we're sitting here in October, it's late February, but it kind of feels like that given how much volatility and uncertainty and headline news there's been year to date. So what we're going to be talking about in this episode is a study we did on the S&P 500 back to 1964, looking at periods where the market fell 10% or more over any given period. And what were those catalysts? So that's the topic of discussion today. And, there's always people worried about the market declining, particularly when valuations are higher or the market has done well or people are bullish. And in a way, we have all of that today, but that doesn't mean the market's going to decline 10% or more. And again, what we're going to be highlighting today is a discussion on the broader markets, not on individual stocks. So let me just get this out of the way. A individual stock can fall for a whole host of reasons, particularly idiosyncratic reasons, earnings reports, bad guidance, whatever. Whereas equities as an asset class typically only fall 10% from a macro event. It's not because a company had bad earnings or two companies had bad earnings. It's usually something much broader. So today there's definitely reason to be on watch, and it's not necessarily because there are imminent risks to the market, but we do have a backdrop where investors are fairly bullish on both the economy and on the stock market. We've gone through 2 good years in the S&P 500, and there's a lot of optimism around the new administration and hope that maybe Powell will get in a few more rate cuts this year.
There's always bearish talking points. What are some of the ones you're hearing? You talk to professional investors, and you're also really active in Twitter.
Yeah, so I would say there's definitely a broader set of concerns when you look at the retail community, when you look at Twitter. People are worried about everything from the market being crowded to somebody who was bearish now turned bullish, some random things like that. Whereas institutional investors, I would say, certainly always focused on earnings. And there's definitely a chunk of the market where earnings continue to be disappointing. Certainly this year in 2025, the risks are mainly centered around the new administration's policies and the risks that those may come with, i.e. tariff risks from an inflation perspective. And then I would say maybe on the growth perspective, you're certainly hearing a lot of cuts coming out of the Elon Musk and his crew on Doge. So there's some concern around future demand if we see a lot of these government agencies see cuts, to both the private and public sector. And then you've got obviously valuation is on any measure really, really high. And we've got really tight credit spreads. So I'd say, we definitely have conditions for a potential correction, but that doesn't mean you're going to have one. You always need a catalyst.
Yeah, valuations, that's the classic bearish talking point. And then today you have the unique backdrop of concentration being so high and those stocks that are the mega caps having done so incredibly well over the last couple of years. Then you had the Walmart news this week that shook a lot of people.
Yeah.
There's definitely things out there at a time, as you said, credit spreads are so tight. So while there's all these talking points for investors, there's really not that much risk priced in. So those are the talking points. What are the kind of things in the study that you were discussing that are the main catalysts? How many are there?
Yeah, well, you just brought up a good point in what you just said. Credit spreads are really tight. And my opinion is that is a reflection of a financial market that is not pricing in much risk or doesn't see any imminent risk. But that's happening at a time where, the list of things you just mentioned and I mentioned earlier, there's so much uncertainty and there's so much potential for risk. So a few years ago, we did a study, and I vaguely remember sitting at my desk with the team and pulling up the S&P 500 on Bloomberg, and we looked at daily closing price chart back to 1960. And we literally scrolled through history looking for all of the 10% corrections that we could find. And with the goal, of course, is to try to find some commonalities behind these, because yes, every correction can be a little different. Some are from recessions, some are from exogenous events, some are from inflation like 2022. But we wanted to really dig in to see what we could understand. And I think it's important because I think if you ask, if you have a conversation with a lot of different investors about why markets fall, I think you'll get a lot of different reasons. And sure, again, there's always different catalysts to each correction, but we found a lot of commonalities. So I'll basically chalk it up to three things from a really high level. And the three things that we found common amongst the 27 10% corrections or greater in the S&P 500 back over the last 60 years were that they either coincided with sharply higher interest rates, rising unemployment, or some global exogenous shock. And obviously that third bucket is a big mix of a whole bunch of different things, from long-term capital management to the US debt downgrade in 2011, et cetera. So obviously the third one is really difficult to predict, whereas the first two, sharply rising interest rates or sharply rising unemployment, i.e. a recession, are more kind of commonplace for macroeconomic analysis in market history.
Wow. So the study really showed there was three things, which is kind of crazy because when you look at today and you ask an investor, what are the reasons markets fall? Just the list today: concentration, valuations, Fed, rates, tariffs, bifurcated consumer, overbought. There's just so many things. But the study really showed there was those three, and very topical today. I mean, rates is one of those things that's on the front lines. So which one of those in the study was the most common?
So when we looked at all 27 of these, some of these had multiple issues. So the term stagflation came out of the 70s, which is periods where interest rates and inflation were rising and unemployment was going up and markets were falling. So some of them had a couple, but when you look at them kind of as what the primary catalysts were, and to determine what the primary catalyst was in each correction, we looked at why the market bottomed in each one of these corrections to address that. In other words, if, let's say, for example, one of the big drawdowns in the 70s occurred alongside higher interest rates and rising unemployment, well, if the market bottomed with interest rates peaking and not unemployment peaking, well, then we could say, well, the market was more focused on interest rates and not the latter. That was a secondary condition. So when you look at all these corrections, again, all of them had different reasons behind them. If you ask somebody why the market go down in 07 and 08, people would say, well, we had a housing crash. Well, yes, that was the catalyst, but the result was that we had unemployment shoot up. And if you look at in 2007, markets really didn't peak until October of 07, which was right around where the unemployment rate and unemployment claims started going up. So where these problems went from being industry and sector specific to systemic for equities overall. So when you look at in all three of these, you see that most of them actually have come from higher interest rates. So of the 27, 14 of those had higher interest rates as the predominant factor. The second most common was rising unemployment, which 8 of those. So those are 8 recessions, basically. And the remaining 5 we would chalk up to exogenous geopolitical global events that took the market down. And then ultimately in those 5 instances, the market bottomed when those issues saw some resolution or were resolved.
So of the 27, over half of them, 14, were due to rates.
Yeah.
Another interesting point you mentioned, which I think is worth kind of covering a little bit, is there's always a lot of things going on as we roll over, but the real problem, the weakest link, and when the weakest link gets better or stops going down, it's when a market recovers.
Yeah, that's a good point. And when you think about why markets correct and why we have bear markets and why markets bottom, of course, people will want to bring up valuation. And we always say valuation is a condition, not a catalyst. And certainly today, I saw recently Bank of America published a table showing something like 20 different valuation metrics throughout history, and 19 of 20 of them were all in overvalued territory. And then in their recent fund manager survey, they showed a survey of how many fund managers said US markets were overvalued. And it was at a very high level. But if you look at the chart, actually, it's been at a high level for like the last decade. So valuation is not really a good timing tool. And I would argue that markets don't fall because they're expensive. I would say they fall because some new risk was introduced into the market at a time. Perhaps it may have been expensive or not. In 2007, the S&P was trading at like 14 times earnings, so it wasn't expensive by any metric there. But perhaps if investors had perfect foresight, maybe that was the most overvalued market in 50 years in October of 2007. So valuation, of course, is only useful if you know the future.
So you just mentioned the financial crisis and some of these past instances. I think it'd be really interesting, Michael, if you could go through maybe the most recent few drawdowns over the last couple of years and talk about what the catalyst was and the backdrop at the time.
Sure. And, why I think this report was really helpful for clients and maybe even more helpful for me and our team was that it helped really frame why we see corrections through history. And, there's always headline, the media is always trying to get you worried, right? Fear sells, and investors are always, somewhat skeptical while trying to remain optimistic. And it helped me at least frame what news and data points I need to worry about and which ones I don't. And, the last couple of years really, I think, highlight what the conclusions are in our reports that, again, it's these major risk off events that pull equities down. And the irony is that in your career, Stephen, and in my career, you started around 2000?
2000.
Yeah. So I started a couple years later. Every correction I saw in equities, and even the one, and you saw, so think of the tech bubble and ensuing recession, think of 07, 08. It's an interesting fact, there were no 10% corrections between the end of the tech bubble and the GFC. And then we had a bunch of them during the zero interest rate period in 2010 to 2020. And up until 2018, basically every market correction, bear market, et cetera, from the very late 90s until 2018, they were all growth-driven market corrections. And so in 2018, when we saw the fourth quarter massive sell-off in equities, which what ended that was the infamous Powell pivot, that was really the first major market sell-off that came from higher interest rates really since the early 90s, late 80s. And what we have seen most recently, really since 2022, has been only periods where really markets have sold off more than 10% coming from interest rates. So the last 10% sell-off, so correction number 27 in the last 60 years, was in the summer of 2023. And the market, the S&P sold off from a closing high to a closing low, just over 10%, and bottomed around late October in 2023. And that was one that was very clearly a rates-driven sell-off. And what I mean by that is that stocks were falling while interest rates were rising, and the market ultimately bottomed around the peak in interest rates. So that's why, we would assign that as being a rates-driven issue. Why rates were going up is less relevant. It's just that was those two things were coexisting. So that was the most recent 10% sell-off. In 2024, we didn't see a 10% sell-off or greater in the S&P 500 on a closing basis. And the one before that summer of 2023 sell-off was, of course, the most of 2022, where the markets peaked on January 3rd and found their ultimate low for the S&P on October 12th. That market drawdown was 25%. And certainly that was, all the fear around inflation and interest rates, that I don't think that one's that debatable. Of course, yeah, there were other things going on, the war in Ukraine, there was fear of a recession, but certainly no evidence of it in the employment data or the earnings data. And again, ultimately, the market bottomed towards the end of 2022 around the peak in CPI. The one before that was 2020, of course, was COVID. And the 10% correction prior to COVID was that fourth quarter of 2018, where Powell basically, let's say, misspoke or misunderstood the markets, and the markets changed his mind. So really what we've seen, putting aside COVID, in the last 6 or 7 years is markets that are going down on interest rates and inflation fear, not growth slowdowns, which is what you and I are so used to seeing for most of our career.
That's really interesting stuff. And one of the cool takeaways I had not picked up on was that gap from the end of the tech bubble to the financial crisis of a little over 5 years almost without a correction, while 1964 till today in that study, you're talking about on average one every 2 years.
Yeah, don't hold me to this, but I don't even think the S&P saw a 5% correction from the bottom in March of 2003 through the peak in October. I vaguely remember doing a study on that. And so, yeah, that was a very quiet period for equities, despite how it started and how it ended. So, yeah, just because the averages say, we've had 27 in the last 60 years, that's roughly one every 2 years, doesn't mean we're going to necessarily get one every 2 years. You really need these catalysts. So, yes, given where the valuation of the market is, the concentration of the market, and whatever your concern is about the market, it can stay expensive, it can stay concentrated until something changes. And that's very clear throughout history, that all of these corrections are very much driven by, mostly, again, either recessions or interest rate spikes. Valuation is extremely inconsistent in looking at market corrections. In these 27 corrections, sometimes the markets were dirt cheap. Sometimes they were, like 2000, really expensive. Sometimes they were concentrated. Sometimes they weren't. So, all of these other concerns we have really have a lot of false positives, or kind of a low hit rate in detecting why markets go down.
So it's not time. It's mainly these three drivers that you've mentioned today and have in the study. So the obvious question, Michael, what are your insights on those three? I know the one's a wild card with the global, but what are your insights on those three key drivers today, and where you see them potentially going? Are they a risk?
Yeah, well, the starting point I think is important today. The starting point being that, like you said at the beginning, there's not much risk priced into markets. And you could see that through elevated valuations. You can see that through high earnings expectations and low credit spreads. So perhaps we're not going to see the PE of the market go much higher. And that suggests, without the PE going up for a third year in a row, the markets are going to be more volatile. And that means that they're going to be worried about more issues, perhaps. And so when I look at those three potential catalysts for a 10% correction, of course, like you said, the third one, the exogenous factor, of course, is difficult to predict, though we certainly have the conditions to argue that probabilities of exogenous issues are higher than normal. I don't have to say a lot more than that. And when we look at, is unemployment likely to move up sharply, or are our interest rates likely to move up sharply, and inflation expectations, is that going to be the next catalyst? Or, let's be realistic. Markets are very humbling. Perhaps something that's never happened before, or at least in the past 60 years, be an event. And again, I would say today is a backdrop where if I was a betting man, I'd say there's a higher probability than normal that something unexpected could happen. That is not a function of high rates or a lot of people losing their job, i.e. a recession. So I don't know if that would come up in the exogenous bucket or something else. But I'd say today it's more interest rates and inflation, given that the Fed's certainly no longer raising rates, and they have cut rates somewhat. And we're seeing cyclical parts of the economy improve, like manufacturing PMIs and small business sentiment. And we have an outlook for a lot of deregulation ahead of us. I would say pro-business backdrop, backdrop compared in some ways that we've had before with the prior administration. I'd say the economy is going to be fine. And that actually puts more risk on that other issue of higher interest rates and inflation. If the economy continues to be quote unquote fine, interest rates are going to stay pretty much where they are, and from time to time could move higher as investors worry about tariffs, so the unknowns, and just respond to better data.
So looking out into the kind of the near term, it sounds like rates, job losses aren't necessarily a imminent risk. And then you have potentially tariffs and all these geopolitical events that could pop out of nowhere. But sounds like you're optimistic on two of the three typical catalysts for market correction in the near term.
Yeah, I think it's, we've been bouncing back and forth over the last couple of, maybe let's call it the last 12 months between minor growth scares, but more often than not, investors and much of the market volatility has come from interest rate inflation concerns. And so I think that's going to continue. And, when you look back at these 27 corrections we found, when we start off the first one in 1966, all the way and including every correction through 1990, they all coincided with higher interest rates. Some of them were also recessions, but they all coincided with higher interest rates. And one of the arguments we've made in our work is that we're in that regime again, where more often than not, the risk to markets are when investors get really concerned about interest rates and inflation, not a growth scare. And we certainly see that in the markets over the last few years. The correlation between interest rates and equities has been negative. It's not always strongly negative, but it certainly really has not been positive when you look at different measures and correlations. And, when you look at consumer confidence data, when you speak to anybody, when you listen to the news, all they're talking about is inflation and interest rates and price level, the prices of eggs, the prices of housing, the prices of, this and that. So everything is expensive, including the stock market, and it could remain expensive for a while here. So, could we see a 10% correction this year? Of course. Is it likely to come from rates or jobs? I think it's the former, more likely to come from rates and inflation expectations. Could we also see correction just because a couple of the Mag 7 stocks take a big hit? Yeah, maybe that's something that could occur given the unique concentration we have in the S&P 500 today. But yeah, I'd say I'm somewhat optimistic that maybe we'll avoid one this year, because I think in a way the economy is too strong to see any kind of sharp increase in unemployment. And I think the economy is too bifurcated, and there are too many problems that show up every time interest rates get to higher levels, let's say above, 4.5% on the 10-year and rising, that start to shake up the market, cause volatility, and it doesn't last very long. So I think we're kind of, with regards to interest rates, we're kind of stuck in a band somewhere between 4 and 5% for the foreseeable future. Yes, there are a lot of unknowns and uncertainties that could change that or could cause the market to go down. But just looking at the base case of what we know and what we could try to forecast this year, I think the S&P 500 probably won't see a 10% correction. But again, you'll have to allow me to change along with the data and along with the news, as always.
Absolutely. Thanks, Michael. This was great.
Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.